The history of banking spans thousands of years, with its evolution deeply intertwined with the growth of commerce, trade, and civilization. Banking has progressed from simple systems of barter and storage to highly complex, global financial networks. Over time, it has adapted to technological advancements, regulatory changes, and shifting customer needs, shaping how individuals and businesses manage money today. From ancient civilizations to the digital age, traditional banking has undergone significant transformation, and the future promises even more innovations as the world continues to evolve. Before starting, don't forget to like and subscribe to our channel for more future updates. The origins of banking. Banking has its roots in ancient civilizations, where individuals and groups needed a secure way to store and exchange goods of value. The earliest evidence of banking practices dates back to Mesopotamia around 2000 BCE, where temples and palaces acted as financial hubs. These institutions safeguarded grain, livestock, and other valuable commodities in exchange for a small fee. Over time, these storage facilities began to offer loans and credit, allowing farmers and traders to borrow goods with the promise of repayment after a successful harvest or trade voyage. In ancient Egypt, Greece, and Rome, banking continued to develop as temples evolved into centers of wealth management. In Greece, for instance, private moneylenders emerged alongside temples, and rudimentary forms of banking contracts were created. The Romans, credited with advancing legal and financial systems, helped spread the concept of banking across their empire. By the time the Roman Empire fell, the foundation of banking had been laid, with elements of deposits, loans, and even early forms of checks becoming common practice. The Middle Ages and the rise of merchant banking. Following the fall of the Roman Empire, much of Europe entered a period of economic stagnation, with banking activity limited to basic transactions. The Church played a central role in providing financial services, but it was constrained by religious restrictions on usury, the practice of charging interest on loans. However, this began to change with the rise of trade between Europe and the Middle East during the Crusades. During the late Middle Ages, merchant banking began to flourish in northern Italy, giving rise to some of the world's earliest formal banking institutions. Powerful families, such as the Medici family in Florence, established banks that dealt with international commerce, trade financing, and currency exchange. These banks facilitated cross-border trade by providing letters of credit, allowing merchants to move goods and money safely across vast distances. The ability to offer loans, manage risk, and safeguard deposits made these early banks essential to the growing European economy. The period also saw the development of double-entry bookkeeping, a system that revolutionized financial accounting. This method ensured that all transactions were accurately recorded, allowing banks to track their assets and liabilities with greater precision. The establishment of merchant banks during this era laid the groundwork for the modern banking system, which would expand and diversify in the coming centuries. The birth of central banking. By the 17th century, Europe's economy had grown more complex, and the need for centralized control over money supply and financial stability became apparent. This gave rise to central banking, a crucial development in the history of traditional banking. The Bank of England, established in 1694, is often considered the first modern central bank. It was created primarily to finance government debt during wartime, but over time, its role expanded to managing the country's currency and providing stability to the banking system. The Bank of England pioneered practices such as issuing paper money and acting as a lender of last resort, intervening to prevent bank failures. The expansion of commercial banking. The Industrial Revolution, which began in the late 18th century, transformed banking in profound ways. With the rise of factories, railroads, and mass production, there was a growing need for capital to finance industrial projects. This led to the expansion of commercial banking, as banks provided loans to entrepreneurs, corporations, and governments seeking to build infrastructure and grow their businesses. In the United States, the 19th century saw the establishment of several key banking institutions, including the First and Second Banks of the United States and, later, the Federal Reserve System in 1913. Commercial banks provided essential services to individuals and businesses, including savings accounts, loans, and the issuance of checks, which became a popular form of payment. The growth of commercial banking was not without its challenges. The 19th and early 20th centuries were marked by numerous financial crises, bank runs, and collapses. These crises underscored the need for stronger regulation and government intervention to ensure the stability of the banking system. In response, governments around the world began to implement regulatory frameworks to protect depositors and maintain confidence in the financial system. Regulation in the modern banking system. The early 20th century saw significant regulatory changes in the banking industry, particularly in response to the Great Depression. The stock market crash of 1929 and the ensuing economic collapse led to widespread bank failures, shaking public confidence in the financial system. In the United States, the federal government responded with the creation of the Federal Deposit Insurance Corporation, FDIC, in 1933, which guaranteed bank deposits, restoring trust in the banking system. The Glass-Steagall Act of 1933 separated commercial and investment banking, limiting the activities of banks to protect depositors from risky financial ventures. Similar regulatory measures were implemented in other countries, helping to stabilize banking systems globally. The rise of digital banking and fintech. The latter half of the 20th century and the beginning of the 21st century marked the rise of digital banking, as advancements in technology transformed the way individuals and businesses interacted with financial institutions. The internet and mobile technology have played a significant role in shaping modern banking, as more customers demand seamless, 24/7 access to their accounts and services. Online banking emerged in the 1990s, allowing customers to perform transactions, check balances, and pay bills from the comfort of their homes. This shift towards digital banking reduced the need for physical branches, as customers increasingly relied on digital platforms to manage their finances. The introduction of mobile banking apps and the growing use of smartphones further accelerated this trend. Banks began to offer more personalized services, such as mobile check deposits, peer-to-peer payments, and real-time notifications. The development of fintech, financial technology, companies has also disrupted the traditional banking industry, as these firms offer innovative solutions such as digital wallets, robo-advisors, and blockchain-based financial services. The future of traditional banking. As technology continues to evolve, the future of traditional banking remains uncertain but full of possibilities. One of the most significant developments in recent years has been the rise of blockchain technology and cryptocurrencies, which have the potential to disrupt the traditional banking system further. Blockchain offers a decentralized, transparent, and secure way of transferring money and conducting financial transactions, challenging the role of traditional banks as intermediaries. Moreover, artificial intelligence, AI, and machine learning are playing an increasingly important role in banking. These technologies enable banks to offer personalized financial advice, detect fraud, and automate processes such as loan approvals and risk assessments. The banking industry is also witnessing the emergence of open banking, where banks share customer data with third-party providers, allowing for greater competition and innovation in financial services. Open banking has the potential to create a more collaborative ecosystem, where banks and fintech companies work together to offer customers a broader range of services tailored to their needs. Despite the rapid pace of technological innovation, traditional banks will likely continue to play a critical role in the global economy. However, they will need to adapt to the changing landscape by embracing digital transformation, investing in new technologies, and focusing on customer experience. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.